You are listening to Keystone Stock Talk Show, episode 256.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to be back. I will start this week's episode by detailing why we look for profitability and growth in a stock as basic requirements for investment. In our Your Stock Our Take segment, Aaron begins with a viewer question on Gamestop Corp, symbol GME, on the New York Stock Exchange. The infamous mother of all meme stocks is a specialty retail that sells new and pre-owned video games, hardware, software, accessories, and collectibles. A slight rebound in meme stock activity. The stock has once again had a volatile month. Following this, Aaron answers whether or not there's anything fundamentally appealing about the business itself. Brett answers a viewer question on Perimeter Medical Imaging AI, symbol PINK or PINK on the TSXV Venture, a medical technology company focusing on cancer imaging tools. The stock is currently trading at 47 cents a share, or 30 million market cap, essentially down 74% over the past year. Brett lets you know if there's anything to the business other than the letters AI at the end of its name. Brennan will revisit a past Your Stock Our Take on NTG Clarity Network, symbol NCI on the TSX Venture, a digital transformation business providing outsourced software development solutions and proprietary software products to telecoms, utilities, enterprises, governments, and finance companies. The stock has performed well since Brennan last answered a question on the business, and he lets you know if this can continue and why the stock has performed so well. All right, let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How are you guys doing? Did you have a good weekend?
Good.
Yep.
Weather's starting to get nice, so.
Yes, yeah. It is. Brennan, you were at a stag weren't you? Or
a stag.
Yeah, whatever. Whatever.
Yeah, it was a stag, and it was a lot of fun. I mean, we ended up playing something like 48 or 52 holes of golf, but it was cold in Saskatchewan. I mean, the one evening we ended up golfing in only +3, and it was raining the whole time. And someone made the joke, "Wow, I didn't realize I flew all the way from BC to basically golf in Victoria in January." Because that's sure what it felt like. But it was a lot of fun. And, our 4-man scramble team did win. We were 4 under. We're the best.
Amazing. You said it's cold in Saskatchewan, and any viewers in the U.S. were just like, duh. And
yeah.
That's what they believe. You live in igloos. That's what.
But I mean, it's usually +20, in June. But yeah, we've been getting lots of rain, and it's been kind of chilly, but I think that.
What about your Oilers?
Well, to be honest,
1.
I didn't watch the full game. I actually missed the first and second period, so I really couldn't even report on how well they played. But I heard from you that maybe a little too many wobbly pops and just too much conversation going when we were out. But I mean, I heard from you that the Oilers had a decent game. It's just maybe the classic 10D story that the Oilers have.
Yeah, they outchanced, and were kind of out goaltended. I mean, there was, I don't think Skinner was that bad, their goalie, the Oilers goalie, but, he certainly did, he provided adequate goaltending. He didn't steal the show, and then Bobrovsky on the other side did. So we'll see. Game 2 tonight.
Yep.
And hopefully the Oilers get summarily drubbed tonight again.
Wow, can't believe you said that.
I'm just kidding. Hey, Canucks fan, that's how we exited the playoffs. I've got to stay on point, right? So
yeah.
Okay, well, let's get to the show. Anybody? Or we got a poll, right? Brett, you got a poll from last week.
Yeah, we got a poll from last week. This is to do with
since we're seeing interest rates starting to rise, Canada's interest rate, cut, and they cut 25 basis points or 0.25% to 4.75%. And I asked, does this change your investment or financial strategy going forward? And we had 13% yes and 88% no. So obviously resounding no. But I think a lot of people, they aren't taking in consideration anything that variable. So if you do play in any short fixed income, so whether that be like the cash ETFs, which are just high interest rate deposits, or just short-term T-bills, or if you have a variable rate mortgage, that should really be start to change any of your equations at this point, because now we do have confirmation that they're actually beginning the cutting cycle. Before it was always, when are they going to start? And now they have started, which normally means they'll do another one the next month now, and then the next meeting would be in September. So are they going to keep on cutting at this point, or is there going to be a pause? That's the next question, because sometimes they do just cut, take a pause, cut, take a pause, and so on. And that's really the cadence we want to see now, or how is the cadence going to be, I guess, is how we need to see.
Mm-hmm. Totally.
Yeah, I think in terms of an investment strategy, I mean, for a lot of people, it wasn't a complete surprise that the rate cuts, at least in Canada, were going to start either this month or the next meeting. But really, the question is, well, how do you create an investment strategy around what the Bank of Canada or the Fed are going to do, right? I mean, most of the time, I don't think they even know what they're going to do, and trying to get in front of that, trying to modify the stocks that you hold. I think you're always going to be chasing the information that was available yesterday, right? And a lot of that, at least in the short term, is already factored into prices. I mean, if the idea is like, oh, I want to switch over into out of defensive stocks or into defensive stocks based on what I think that the Fed is going to do, you're always going to be chasing something and never quite there. So it's really important to set a strategy that's going to work well throughout the cycle, and in a wide range of scenarios, regardless of what the Fed or the Bank of Canada decides to do.
Yeah, and if we do believe there is going to be a rate cutting cycle going forward, I mean, you may be looking at good quality dividend stocks, but that shouldn't be the reason that you're investing in those anyways. It should be because it's a good business and they're going to grow that dividend.
Yeah, and if you're looking long term, you're probably wanting to invest in good quality dividend stocks
all the time,
regardless, right?
Yeah.
Regardless of what you thought. But that
if there is a rate cutting cycle,
you're going to invest in, you're also investing in small cap growth stocks, and other areas as well.
If there is a cycle, I guarantee you're going to hear that after about the second or third rate cut, when you probably should have already had those good quality dividend growth stocks in your portfolio. This is now the time to get in. So, it should be just based on the quality of the company that you're investing in. If it happens to be a dividend growth stock, those are companies that we like to invest in over the long term. You're probably already in that, and then you take advantage of that over that time in your portfolio.
I would say it obvious for stocks. Like you said, we want to look at the stronger companies because it's hard to predict. And even on the fixed income front, if you look at the curves in the previous days prior to the announcement, you could already see the market had previously priced in that 25 basis point cuts into the Canadian treasuries at that time. So you had to be preemptively doing your position and react to gain any of the upside, even in the fixed income market. Yeah. But that also, you can maybe start to look into different fixed income, especially on the short end of the curve, depending on your outlook. But if you are just playing reactionary, you're not going to really do much more than what you already are.
Good. All right, let's get to the show. We got a busy show again this week. So I'm going to start. So I did a brief presentation last week. I added a little bit for the show here today and took out some, but I'm just going to do a little bit on that just to give you an idea of why we really do focus on growth and profitability. I'm going to show you a study in that area and some of the key variables that were in that study that proved kind of why we look in this area. We started about 25 years ago looking at small cap stocks. And when I say that, I don't mean tiny businesses, but those with market caps of say under 500 or 250 million in the Canadian market, billion in the US market at the time, right down to stocks that are 10 to 20 million in market cap. So real micro or nano caps. These segments are underfollowed. They can grow faster And here you can find mispriced stocks. It's core to our philosophy is to uncover and invest in wonderfully profitable businesses. Profitability is a basic requirement in every investment, as well as growth from those businesses. But why do we focus on that profitability? Well, I'm going to get into that today. There was a study done recently by Henrik Bessembinder. Just call him Hank here. It's a lot easier to say. He's a rather acclaimed finance professor. He studied whether stocks beat T-bills long term. His answer was a qualified yes. The study looked at 26,000 stocks from 1926 to 2015. He analyzed long-term stock returns. He examined 20 variables. Only 3 of those variables were really found to be statistically significant. The most significant variable was net income growth. Not because of this study, but we do know this as a driver of stocks. But this is why we see net income grow and growth in that income as core tenet to any investment that we make. So on the flip side, one of the areas that I look at specifically is profitable Canadian and US small caps. But why do we look at profitable small caps? Your question might be. Well, let's look at a study over the past 10 years period, returns, for example. If you look at 87% of all global equities that went up 1,000%, those are the type of stocks that can really drive your portfolio. Everybody's looking for those 10 baggers. So over the past 10 years, 87% of them started off as micro or small cap companies. 82% of those were profitable at the start of their ascent, and 91% had some history of profitability. For us, the key is combining small, growing, profitable, good businesses. This is kind of what we do in our research. I always like to give examples of how powerful combining low price and low valuation, profitable and growth stocks together can be. This is an example of one. Again, it's the best performing stock in Canada over the past 5 years. Most Canadian investors have never heard of this stock. Why? Well, Hammond is a leading provider of electrical transformers, and it's a company we've long seen as kind of a backdoor way to play the electrification boom. Love it or hate it, it is here. It has historically been profitable and has grown out of internally generated cash flow. Hammond has never needed big banks or brokerage money to fund its operations. These are the best types of businesses, but Bay Street pays them little attention, and it's the detriment of Canadian investor portfolios. But we can take advantage of opportunities like this, and that's a great example of a company who has had a tremendous outperformance, started as a small cap, and is now graduating to be in at least the mid to cap range in the Canadian market. Now, I'm going to look at a little bit of background on Hank's study that we talked about there. Just kind of what compelled him to do this study to start with. Well, Bessembinder got into the stocks versus treasury bills question really accidentally. Initially, he was looking at data on continuously compounding returns for stocks and noticed that the average was negative, meaning that a lot of stocks were losing money. So he didn't understand how that could be, given the fact that the overall stock market does make money in the long term. So he wanted to know why. His investigation ended up documenting the importance of the statistical concept of skewedness for the stock market and investing in general. In particular, he found out that returns from long-term stock investing are positively skewed, meaning that very large returns in a few stocks pull up the average, while most stocks post modest or negative returns. So here are from the study, some of the biggest points that he found. Because of skewedness, he found that here you see Treasury, 58% of stocks failed to beat Treasury bill returns over their lives. 38% of stocks beat Treasury bill returns by just moderate amounts, and just over 4% of stocks are responsible for boosting the market's overall returns higher than those on Treasury bills. So it's kind of shocking to some people to see that, but if you look at the returns, if we can look at the top 20 wealth creators over this study period, you can see here some of these names you should be very familiar with, some of the biggest companies out there. But if you look at Apple, this was again up to 2017, not the 2015 that I quoted. There's 2 more years added on to this, but Apple has generated more wealth in the stock market than Exxon, despite being 50 years younger. Now, those numbers for big tech that you see on this list here have gotten even larger. They look even more impressive today. But you can see these long-term winners and how they have created much of the wealth in the market over time. And one of the things we say, it does not take many great stocks in your portfolio to make a monumental difference over the long term. Having just 1 or 2 of these stocks in your portfolio over the past 40, 50 years could have been monumental in terms of driving growth. And that's what we're looking for every day, starting with good, profitable businesses that have the potential to grow over the long term and power the returns in your portfolio. They also allow you to make mistakes on other firms, because you will make mistakes on other investments in your portfolio. But if you have a great long-term winner, it can power your portfolio and help you over the long term. All right. Any further?
One thing that I'll note is that on that last slide that you showed, that data was up to 2017, and it had Microsoft at a $800 billion valuation market cap. That's
it is amazing.
Now in 2024, almost 3.2 trillion, right? Yeah. So it's those numbers would even look better if
Alphabet was just over 500 million. Even Alphabet or Apple at $1 trillion. Amazon at just the same range of Alphabet there, 550 billion. But just the gains that have been made there, these returns, the power of these returns from these companies has created far more wealth. That it was impressive at this point. It's the skewedness in terms of the market has been even more impressive over the last, just to add 5-6 years to that. So.
Yeah, I'm glad that you did this segment, just because, the company that I'm doing, this small cap or this nano cap company, the stock is up over 300% since I covered it last on the podcast. And it
can't believe it's not on that chart.
Yeah, well, it's tiny, but it is, earnings per share growth that has been driving the stock. And obviously I'll get into that, but I just, again, that's what we're looking for. Not only being, earnings positive, but also having growth. And that's going to be the big question around my segment is, will this growth continue? Anyways.
Well, and we see that. I mean, maybe we can do a segment at some point talking about like EBITDA and those other, how they tried to use those on a per share growth basis. And the basic, this study, over from 1926 to 2015, the biggest variable was just basic net income growth that over time, and that is over the long term, but that was the biggest variable in terms of impacting the driving the share prices. So it's one of the reasons we pay attention to it. Again, not because of that study, but just from looking at the markets for 25 years and seeing which stocks from our research, outside of our research, actually grow over the long term and power those returns that we're looking for in client portfolios. And it's companies that move the needle on net income growth, cash flow per share growth, all of those things.
Yeah, and interesting enough is when we think about bubbles like the 2001 tech bubble, when what happened was we deviated off net income and cash flow into sales or clicks or something like that, alternative metrics.
That was the scariest times for me when I look at the markets, without a doubt. Yeah.
Yeah. Well,
it's hard at the time when you're in the market to, well, maybe we should have a new metric that we use. Maybe we shouldn't. But it always reverts back to the growth in the profitability on a per share basis.
It's like CloudMD. We're just running the segment up and up here, but like CloudMD, which I did last week on the podcast. I even said in my segment, there was people trying to justify that this thing, it was trading at 9 times sales, and they were saying that CloudMD should be trading at 15 times sales. So it's just, again, it was in this crazy environment. And it's hard, when you are in it to, see the forest through the trees, I guess.
Yeah, you just got to read those studies over and over and just keep looking at them and know like
Yep.
there's times to buy and not times not to buy. You buy less at those times or very selectively.
Yep.
All right, we're going to move to Brett's segment. He is doing Perimeter, a company with AI at the end of its name. I do know that. It's a TSX venture listed company. Its symbol is pink, I believe. And we're going to see if this company deserves your further look in your portfolio. I think I've got an opinion on it, but I'm going to let Brett take that.
Yeah, so like Ryan said, the name of the company is Perimeter Medical Imaging AI. So that AI right now, I think, should give a red flag to people because some companies are just sticking it in their name or in their name somewhere, or artificial intelligence in some form just to get that stock market boost, since it's been in every single conference call, or what seems every single conference call for the last year and a half. So does the company have really any substance? So Perimeter Medical Imaging, AI symbol PINK or PINK on the TSX Venture, is a medical technology company focusing on cancer imaging tools. The company's current product stack includes Perimeter S-Series Optical Coherence Tomography or OCT, Tissue Mobilizer, and Atlas Image Library. It has an AI software in development as well as its B-Series OCT, which is currently in clinical development awaiting enrollment of potential users. The technology's goal is to better allow surgeons to achieve clean or negative margins on surgical cuts to remove cancer, which effectively means the cancer has been fully removed. The OCTs allow for real-time monitoring at 10 times the resolution of an X-ray, and the AI integration in the future would hopefully be used to identify cancer cells. Effectively, the goal of the company's products is just to have better cancer removal in layman's terms. Looking at the company's share performance has not been great. However, the stock is currently trading at 47 cents a share or 30.6 million market cap, down 74% over the past year. So let's dive into why has the company's stock fallen so much. The company has really no significant revenue, only 98,000 in the last quarter, and it's been around that 100,000 mark for a while now. And as the company is actively marketing, developing products, it does have significant expenses as well. Sales and marketing of 1.3 million, R&D of 1.4 million, and general and admin of 1.9 million. Normally, the company does have some offsetting FX gains of 900,000 and 1.6 million in net finance income. FX gains is out of control of the company and aren't inherently recurring. Last times they do actually revert with the nature of FX. As well, finance income isn't primarily due to net interest income like you do with many companies like this, which they do have a cash balance sheet. However, it is due to 1.5 million in warranty liability reevaluation. Warrant revaluation resulting in a gain. Effectively, the share prices drop, so warrants aren't in the money or likely as to be in the money. Substantially lowers the likelihood that they'll have to actually issue shares, resulting in a gain on their income statement, but it's really just accounting, and it's not a real money gain, and it's actually to do with their share price dropping, so it's not even a great thing to see at that. The resulting of all of this is a net loss of 2.1 million for the quarter. Switching to the balance sheet, like I said, the company has cash of 10.6 million. However, as we can see, the cash balance has just consistently dropped over time. You can see that big jump up at Q1 2022, and that's due to them doing a private placement, raising 48.7 million at the start of 2022. And since most medical device companies or development companies, they've burnt through cash over time. You can see that relatively consistent burn quarter over quarter, as they don't actually bring really any cash in, only out. And we can look at the cash flow statement to really drive that point home. We can see the company had a cash deficit before working capital changes of 4 million, and after working capital changes for operating cash flow, which includes receiving grant money of 855,000, there was still a deficit of 3.6 million. So the company is really burning through cash, and that's not an abnormal quarter for them. That's a normal quarter in that range. So the likelihood is they're going to need to raise cash likely within the next year, given they have 10.6 million. You can roughly annualize 3 to 4 quarters, depending on if they cut back or any additional grant, which they are expecting a bit more grant money to come in. They expect another 2.4 million in grants to come in over time, and they have about 1.5 million of receivable on the balance sheet, but they're likely to get that 2.4 million, which isn't directly on the balance sheet at this time. But even then, you're looking probably close to 4 quarters or so cash runway at this time. So looking at the company's long-term plan, Perimeter is looking to use that S-Series OCT, which is their current one that is actually getting delivered in some capacity, as an initial seed for adoption, and then leverage that network of people who are already using it with their B-Series and then that AI imaging technology. And then that's where they actually plan to get some sort of return. So the company is spending significant money on marketing, but they won't likely get that money anytime soon, as they need to wait for that B-Series launch. The company is looking at completing enrollment for the B-Series and Image Assist AI to be completed in Q4 2024. So that's looking at effectively 3 quarters from this point, which means at that point they would effectively burn through all their cash at this rate before they're even done that initial clinical testing, because that's only enrollment, of course. So likely they're going to need to raise additional capital just to develop the product to market, which as an investor, when you're looking at these sorts of companies, how long do they have until they need to raise additional capital? And for Perimeter, it looks up to be about a year, unless something drastic changes in the company, which can sometimes happen with companies in this space. Concluding, the company, like many medical development companies, is on a cash burn-driven timeline and has significant getting to market risk. First, the product needs to be viable, which at least it does seem to be in this case. There is some viability. But then it needs to be adopted, which is why you're seeing that high marketing and sales expense compared to their current cash, or especially compared to revenue at this time. And then it needs to be scaled enough to be profitable or cash flow positive on the initial cash burn timeline. And that doesn't seem to be happening on their current trajectory. If the company does beat the odds and does make it to market in a profitable manner, I would take another look. But for now, I would just pass, given the significant risk of getting the product to market, and given that they only have really a year left in cash at this time.
Yeah, that's a good summary. They may be doing some good work in their field for sure. But we look at companies from a profitability basis. It just isn't there. It doesn't meet our criteria. We'll monitor the business, but it cannot be a buy in our research right now because there's no cash flow there and really nominal revenues.
Yeah, and I'll really drive the point home is, remember, you're investing in the equity of a company, not just the product. So even if the product does good 5 or 10 years from now, if it's groundbreaking, if you get diluted 10 or 100 times, which does happen in these companies, they'll roll back. And that's why you'll see sometimes some obscure and strange price charts. Mm-hmm. But if that happens, your shares, even if you invested $1,000 and it becomes world breaking, it helps really treat cancer. And obviously that's a great thing. But as far as your investment goes, is you likely didn't make any money if you invest in these companies and they dilute 10 times, 100 times before it really does anything.
Yeah, exactly.
Yeah. And there are other options. Like we're looking at biotech, pharmaceutical type company. There's one we bought in the fall, but we're looking at one right now. But you can buy them with net cash positions, growth business, and like under 8-10 times earnings. And if you want to own and have exposure to that segment, there are far better companies that trade at low valuations that can be bought today. And we would look at those businesses versus one that's really in the initial stages that you're taking a massive bet on right now.
Mm-hmm. Exactly.
All right, Brennan.
Yes.
You're going to revisit NTG Clarity.
That is correct.
A company you looked at in the past, IT related business. I'll let you take it away.
Yeah, so I'll take it away here. I covered NTG Clarity Networks on the podcast for Jeremy back in October of 2023, while the stock then traded at about 3.5 cents. And at that time, I indicated that given its low PE multiple, and if it could replicate its growth over the past 3 years and achieve its guidance, there was a case to be made that the stock offers investors deep value. And given the strong share price performance, I thought that I would do an update on the stock to see what is driving the price higher. So NTG Clarity Networks Inc., or NCI on the TSX Venture, currently trading at a price of about 82 cents and has a market cap of around $32 million. So the company is a digital transformation business providing outsourced software development solutions and proprietary software products to telecom, utilities, enterprise, governments, and finance companies. And the company has offices in Canada, the US, Egypt, Saudi Arabia, Oman, and Turkey. Oops. There we go. Now, looking at the stock chart here, you can see that the company did a 5-for-1 share consolidation in early 2024, reducing the number of issued and outstanding shares from about 188 million to about 37.5 million. So given the stock was at just 3.5 cents when I did cover it in October of 2023, post-consolidation, the share price was actually around about 18 cents rather than 3.5 cents. So since then, the stock is up around or over 355%. So just looking quickly at the company's revenue distribution, about 85% comes from professional services and 15% from products and software. And their professional services include things like IT, software development, and telecom resources, which include things like custom software development and system integration, as well as user training. And on the other side, their software products include their NTG apps or their network inventory system, as well as their NTS for utilities, telecom, and their IT sectors. So looking at the financial results and what has been driving the share price. So this is for Q1 of 2024 for the period ended March 31st, 2024. Now, revenue was up 92% year over year to 11.76 million. And this was primarily due to increasing revenue in Saudi Arabia, which is a rapidly growing market in need of technology and software to help meet their growth goals. Net income was up about 274% year over year to 2.3 million. Again, due to the increase in revenue. And EPS, or earnings per share, was about 6 cents per share, up significantly from, it was about 0.004 cents per share in Q1 of 2023. But if we actually take the share consolidation into account, the company did more like 3.5 cents per share the same quarter a year ago. So EPS was up more like 70% year over year. Good growth, though. And this is what's been driving the stock. So looking at the balance sheet, they have cash of about 500,000. Debt and leases were about 7.1 million. And most of the debt is held by a numbered company, which is controlled by the company's CEO, with an interest rate on the loan being prime plus 2%. And that provides net debt of about 6.54 million. And a trailing net debt to EBITDA multiple of about 2 times. Now, because profitability and revenue have went up, we've seen the net debt to EBITDA multiple come down a bit from the last time I covered the stock when it was about 2.5 times. So, if we can extrapolate and we believe that they are going to continue to, have these levels of revenue and profitability, this should come down a little bit more in the following quarters as well. So, back in October of 2023, Jeremy provided me with some 2023 revenue projections, which I couldn't specifically find published by the company anywhere. But he quoted that for 2023, they were guiding towards 24 million in revenue and about 4 million in earnings. And in the fiscal year, the company ended up doing about 27.7 million in revenue and net income of about 2.3 million. So they beat on the revenue and were shy on the net income side. Now, for 2024, the company anticipates continued strong growth from Saudi Arabia as they continue their digital transformation. And the company is guiding toward 50 million in revenue for the 2024 year, which would be about 80% growth over 2023 and a 10% profit margin, which would provide a forward PE multiple of about 6.2 times. Now, to conclude, the company has shown good growth over the past 3 years, primarily driven by Saudi Arabia. Now, the stock is trading at a very low forward PE multiple of just about 6.2 times. But this is somewhat expected given the weak track record of the company, as well as, just exposure to the Middle East. And it is a small company overall. But it's still intriguing, I would say, that forward multiple. Now, the balance sheet is reasonable with net debt to EBITDA of about 2 times, down, like I said, from 2.5 times the last time I covered it. And the share count is much more appealing following, the 5-for-1 consolidation. If the company can continue to execute on its growth and profitability, there could continue to be, value in the stock. But again, due to its lack of track record, tiny size, lack of liquidity, and exposure to the Middle East, it is certainly more high risk. But, for someone who has a risk appetite, it is intriguing if, again, you believe that the company will be able to grow, not only in 2024, but also, into 2025 and beyond. And that's just something I don't know if I have too much confidence in. But again, it's certainly an intriguing story.
Yeah, that's 6 times price to earnings multiple. I mean, it looks attractive on face value, but as you said, it does reflect a lot of the risks of the business.
Yeah, certainly a ton of growth in that last quarter. Really a massive breakthrough for the business in that quarter. Now, if they can do that in every quarter going forward, it's a tremendous value. But I don't think they're guiding towards that. That was probably a near-term record quarter for the business. I mean, we can look at it further once again, but interesting based on that last quarter for sure.
Yeah, and I think again, they're guiding towards, 50 million in revenue for 2024. They did 27 million in 2023. So, they're looking at good growth here. But again, it's just it would be interesting. We should book a call with management here just to get their opinion. I'll do that. And maybe we can talk about it on the podcast as well. But just, for further growth looking beyond. And especially if that hits the bottom line in their presentation, they talked about.
And the nature of the business, contract driven versus recurring. And because there is some of the IT providers that also traditionally have quite low margins and, you're very contract driven. You run out of a contract and suddenly you have a couple of weaker quarters. And the margins of some of the IT service providers have been a concern for us over the long term. So those are all the things that we'd have to look into further on NTG.
Yeah, and just where they're really getting their money from it right now is just Saudi Arabia.
Yeah,
it's the vast majority lion's share, and that's really to do with their Vision 2030, which that's where they're investing in all that tourism. It's the golf tour, which I'm sure Brennan loves.
Yep.
And a bunch of other things, esports and things like that. They're really investing in tourism, digitalization, and all that. And they're just pouring money into it. But they've already pulled back on a few of their more ambitious products. The line, they've already, if you've seen that giant city, they've already pulled back on that scope. So if they do see,
confirming the sustainability is what we're
exactly
looking at.
This would be a minor drop in the bucket for their spending. So, but if they do start to pull back on a bunch of things, is this sustainable, or are they just going to see one day it just cuts off? They're not getting funded anymore.
Exactly.
Yeah. And they're targeting a profit margin of around 10% on that 50 million, right? So, interesting. We'll continue to look at that. And is that net profit, or is that an EBITDA margin?
They say net. They say net profit margin. Again, and they don't provide adjusted EPS or adjusted net income. So again, I believe that that'll be IFRS.
Yeah. Okay. Interesting. All right. We can move forward. Aaron, are you able to come
I'm
forward?
Ready to go here.
There's no drilling or things falling in your head?
There may be at any time.
We will deal with it. It'll be fine.
Resume, but for now we sound okay.
Yep.
Good. And you're going to look at the mother of all meme stocks. It is GameStop, a company you absolutely love fundamentally. True.
Okay, so GameStop, as Ryan said, the mother of all meme stocks. For those of you that don't know what a meme stock is, don't worry, we're going to get into that. But the company, GameStop Corp, trades under the symbol GME on the New York Stock Exchange, about $24 per share right now. It's been a wild ride for the company, $8.5 billion market cap. And what are they? Well, aside from being a meme stock, the actual business is they are a specialty retailer that sells new and pre-owned video game hardware, software, and accessories and collectibles. So they operate in physical stores in 14 countries, and they also have an e-commerce platform. So, what is a meme stock? We keep referring to GameStop as being a meme stock. Well, meme stocks are a type of company or a type of stock or a trading strategy that became popular initially in 2021. So essentially what they are is they're stocks that experience a sudden surge in popularity and price due to coordinated efforts from retail investors that are pushing the stock on social media platforms like Reddit with the famous subreddit Wall Street Bets. Typically what happens is influencers on these big stocks trading forums, they target companies that are heavily shorted. So people are essentially borrowed stock in order to short it, to sell it short, because they're betting on the fact that the stock is going to continue to decline in price. But what happens is when you put a little bit of upward buying pressure, a lot of these shorters get stopped out, which means they essentially have to cover their positions, exit their positions, and that causes more buying pressure and moves the stock prices up. So they're essentially trying to trigger a short squeeze on these stocks by pumping out a lot of social media content on the companies. And it really doesn't matter what's going on with the businesses, what the businesses do, or whether or not they're profitable. They're really just picking stocks that are heavily shorted to trigger that short squeeze. So if we take a look at the 5-year chart on GameStop, we can see that it's been an incredibly wild ride for the company. It was right around this area here in 2021 when the meme stock craze began, and GameStop essentially shot through the roof, going up from about little over $1 to $80, over $80 per share. Then there's been a considerable amount of volatility since then. More recently, if we look at the 3-month stock price here, stock chart here, we can see that there's been a resurgence in the company's popularity. And that is due to a resurgence just in the popularity of meme stocks in general. So why is interest in GameStop exploding right now? Well, one is just a general meme stock resurgence. There's renewed interest in GameStop as part of a broader resurgence in the meme stock trend. So essentially, a lot of these influencers are now targeting companies like GameStop, and this has resulted in the volatility that we've seen recently. GameStop also continues to have a high level of short interest, which creates the opportunity to trigger a short squeeze, which is one of the reasons why the company is still of interest. And then, of course, once we see these wild swings in the stock price, the speculative traders come in because they love to see that volatility and they want to trade on it. So these are 3 of the reasons. And if we look at just the interest in meme stocks over the past 5 years, we go back again, 2021, there was a huge resurgence in the number of searches on Google for meme stocks, indicating a high level of interest. And then it just again, more recently, starting in May, that resurgence happened again. So why don't we take a look at GameStop's financial results and see if there's anything here to justify some of the increases in price. So the company just put out its Q1 results. Net sales, $882 million. That was down 29%. Operating loss and net loss improved slightly, but still the company is losing a lot of money, both on the operating loss line and the net loss line. And then when we look at the company's historical financial results over the last 10 years, we can see revenue has really been trending downwards largely over this period. And the company has not turned a profit essentially in 5 years. So losing a lot of money between 2020 and 2023. So our take on GameStop financially, and of course, we're always looking at the profitability and the financials. This is a weak company, largely in decline. I don't see any financial reason to purchase it. It's really just a trading stock right now. So it's a pure speculation. And for anybody who's interested, who hears about this company on the news, just stay away from it. It's not the type of stock purchase you want to get involved in.
100%.
So I apologize if there is some noise in the background there. There is some construction going on. So
Yeah, like, just long term. Like, I mean, looking from 2015 to 2024, GameStop has a revenue compound annual growth rate of -6%. And like I've talked about it on the podcast, like no one goes into, well, I mean, maybe some people, but no one goes into like a physical brick and mortar store to buy a video game for their, PS5 or Xbox anymore, or their PC. I mean, maybe Brett can talk to that about a little as well. But, generally the last like 6 or 5 video games that I have bought, or probably even 10, like it's been for quite some time now. It's all just done. I don't even have to leave my house. I just buy it on my PS5. It instantly downloads. Even like the new PS5s, you can either buy the one version that is completely digital with no CD, or the one with the CD. I mean, I have the complete digital one. Again, I mean, this isn't revolutionary. That, like Aaron said, the financials aren't great. But it's just it's time before, I think that they completely go belly up.
Yeah, you can just look, like their revenue dropped 30% year over year.
Yeah.
They've already done their cost savings. They already cut back on their costs. That's what they're doing between 2021 and 2023 is they cut back a ton of costs. And during the same time, you have to remember, during the initial meme stock phase, they had a bunch of debt. They got a free pass. They paid off their debt with a raise at that time. They did another raise last month during that initial May jump up in price for, I think it was about $1 billion for 45 million shares. And now they just issued last Friday, so they haven't been placed. We don't have what they actually have placed for how much yet. They're offering up another 75 million shares, which could raise, at the current prices, somewhere around $2 billion more. Depends on exactly what they're able to do. It's not exact. You'll see some headlines that'll say 4 billion because the price was doing that at the time, but now it's dropped now about 40-50% since that. So really how much money they'll raise, who knows, until that it actually comes out, because it depends on the exact timing of their selling. But the point is they've pretty much got a free pass due to the meme stock craze. And I really want to dive in a bit to the why people are actually investing in it. It wasn't initially really influencers pushing it. I think it was just great timing, because I was watching Wall Street Bets since, I think, like 2016, 2017. So well before it was widespread. I was a hipster in that, obviously. And it just never really came popular until COVID. People were locked inside. And then suddenly you saw people, hundreds of thousands of people not normally looking at financial markets. They all hopped on Robinhood at the time in the US, bought up because it became popular. It really started in more like stock. I forget it. I think it was Stockhouse or one of those forum threads, not even on Reddit, where Roaring Kitty, the guy who people are calling an influencer now, I don't even call him an influencer, because that was never really the initial goal of it. It was, he just saw a position, it was overshorted. And then you had people jump in, I think it was November or maybe October 2020. And then it really scaled from there very quickly. You had Wall Street Bets go from a few 100,000 people subscribing to the subreddit up to 15 million or something it is now. And I think it got up to 11 or 12 during that period, but it's up to 15 now. And it really just took a hold. It was that mania, and it wasn't really caused by one person. And you've had plenty of people obviously try to recreate it. And you're seeing Roaring Kitty try to recreate it recently. Again, he's come back. But it's not really working because you don't have the environment where you have millions of people locked indoors who normally wouldn't invest. You don't have that. And you don't have the condition.
And like, even because, sorry if you're listening, but one of my bonehead friends put some money in GameStop recently. And I mean, he was...
Name names? What's his name?
Yeah,
I'm
what's
not
his
going to
name?
say.
What's
I was with him this weekend, but,
you've narrowed it down.
he was up, I think, like, after... Like I don't know, like 20% on Thursday or whatever. And then all of a sudden the stock was down 40% on Friday. And, he's back down and he's thinking, oh, geez, I should have sold. When you're buying a stock that you don't even, he's a gamer. He doesn't even trust. He understands the financials are crap. at least if you buy a business where like you it's a good business and maybe the stock goes down, at least you're holding a good business and you know why you're holding it. At the end of the day, it's like if I asked him, well, why'd you hold it? Oh, well, I got sucked in. Like that's what it would have been, or what it would be.
A fool and his money, right? I'm sorry. But
again, hopefully this doesn't get too much. I love all my friends.
It's a gamble. I mean, it's the companies in the investing world, like it's a sideshow. Like this is a sideshow that, I mean, initially there was a situation identified in terms of the shorting position and everything that, somebody smartly made some money, but like actually investing in it, which people sort of are thinking they are at some points. There's no fundamental reason to be investing in the business right now, like in terms of the underlying cash flow, revenues, growth, all of that.
Yeah, and the irony is, even though it's in a fundamental better state because they raise capital, that's destroyed really the short that they would do. The MOAS theory, the mother of all short squeezes theory, is fallen apart because they raise capital. When you're increasing the shares by, I think it's like 30 or 40%.
I mean, if I was management, I would raise as much goddamn capital as I could right now, like this. And anytime it's moved up, and then, credit to them for doing that. But just looking at the underlying numbers of the business, you shouldn't be, near the stock with a 10-foot pole valuations you've seen recently. So
yeah, and it's just like socially, I just don't even, even if they raise a boatload of money, it's like, where do you take the business where it's going to potentially survive and thrive? Where I
take the billions and do something else.
Exactly.
That's
like,
and,
they literally should, in my
honest.
opinion, because socially, or just, that's the trajectory's not there anymore. I mean, people are doing everything online and just downloading things.
But the thing is, we know.
Yeah.
The thing is, we know businesses with, billions or hundreds of millions in cash in the bank that are actually profitable, trading at reasonable valuations, create dividends or paying those over time, and have the growth that we want in the company. And those are the companies you should be investing in. Again, beat your friend over the head and tell him that over and over again. I've had to do that with some of my friends, and it ends up working far better for them in the long term, and they'll sleep better at night. And again, they're all looking for those blue sky type returns. Well, earlier in this show, we put up a company, Hammond Power, that is as boring as all hell. They make transformers, been around 100 years. That is the best performing stock on the TSX over the past 5 years. That's what you want in your portfolio, not I'm going to be a bleeping meme stock. That is not what you want in your portfolio. You're not going, you think that when we're talking about, a lot of people, I believe, think when we talk about revenue, earnings, cash flow, well, then you just get a business that can do like, maybe 8% on an annual basis. Well, the reason for investing in Hammond Power is not because they're the greatest electrification stock on the planet. That helps that they sort of play into that. It's because they had good cash flow, good earnings, good revenue, consistent business, traded at very low valuations, and increased their dividend over the past 4 years, like 200+%. That is giving you thousands of percent, not a bleeping meme stock that has no underlying value. Okay. So that's, again, my rant for today. I think Aaron's had his building collapse on himself, it looks like. So hopefully he's okay. We'll let you know next week. But again, I think that'll close out our show this week. As always, I thank you for watching. But if you are watching this right now on YouTube, smash that subscribe button. If you're listening to this wherever you consume your podcasts, we like to hear those positive reviews. So rate and review us there. And as always, I'd like to wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.